1937, archaeologists excavating a Roman villa in Britain found something unexpected beneath a collapsed floor. A ceramic jar containing 2,000 silver coins, carefully buried around 400 AD. The owner never returned to retrieve them. Perhaps they died suddenly or fled an invasion. But the intention was clear. These coins were meant to be savings, preserved for future use, protected by concealment. For centuries, this was how people saved. Not through accounts or interest-bearing instruments, but through tangible objects buried, hidden, or locked away. The logic was simple. If value could be held physically, it could be protected. But preservation wasn't as straightforward as burying metal. Empires fell, currencies debased. What felt secure in one generation became worthless in the next. Across history, people adapted, choosing grain, then land, then different forms of credit, each trying to bridge the gap between present resources and future needs. The common assumption treats savings as simple postponement, earning today, spending tomorrow. The historical reality involved more nuance. Preserving value across time required adapting to changing conditions, judging which forms of wealth would remain reliable, and accepting new risks when old methods faltered. The question becomes, how did people across different eras try to make value endure? To understand how people preserved savings across centuries, it helps to enter the worldview of societies where the future feels far more uncertain than it often does in modern contexts. In ancient agricultural civilizations, Mesopotamia, Egypt, early China, survival depended on managing irregular harvests. Good years produced surplus, bad years brought scarcity. The challenge was carrying abundance from good times into bad times. This wasn't investment in the modern sense. It was insurance against famine. Grain storage became the earliest form of savings. Mesopotamian temples functioned as warehouses, holding grain deposits on behalf of individuals and communities. The grain could be withdrawn during lean periods or used as collateral for loans. This system worked because grain had intrinsic value, it could be eaten, and because temples were relatively secure against theft. But grain had limitations. It spoiled over time. Rats and insects consumed it. Floods destroyed it. Storage required ongoing effort and wasn't perfectly reliable even under ideal conditions. People accepted these limitations because alternatives were scarce, but they understood grain was imperfect savings. Metals, particularly gold and silver, offered different properties. They didn't decay. They were portable. They were divisible. And they were universally valued, making them useful for exchange across different regions and periods. When struck as coins with official stamps, they became standardized units of value. For centuries, holding metal felt like the most secure form of savings. Yet this too had vulnerabilities. Metals could be stolen, which is why hoarding, burying jars of coins, hiding them in walls was common. More subtly, the value of metal coins could be undermined by rulers who debased currency, reducing precious metal content while maintaining face value. Savings eroded invisibly as the coins themselves became less valuable. By the medieval period in Europe, land ownership emerged as the preferred savings vehicle for those who could afford it. Land produced agricultural income annually. It couldn't be stolen easily. It passed across generations through inheritance, maintaining family wealth over time. Feudal social structures reinforced this pattern, tying status and security to land possession. For peasants without land, savings options were limited. Some kept small amounts of coins. Some invested in livestock, animals that could be sold in emergencies. Some relied on community networks and reciprocal obligations rather than material accumulation. But the ideal, the goal many aspired to, was acquiring land. This worldview, where tangible, physical assets felt inherently more secure than abstract claims, dominated for millennia. It reflected rational assessment of available options. Institutions were fragile. Political stability was temporary. Paper promises could be repudiated. Tangible assets, whatever their limitations, seemed more reliable because their value didn't depend entirely on others' integrity or institutions' persistence. The evolution of how people preserved savings across centuries unfolded through overlapping phases, each reflecting available technologies, institutional structures, and accumulated experience with various methods. Grain and metal storage. The earliest deliberate saving involved storing excess grain. Evidence from ancient Mesopotamia shows granaries dating to at least 5,000 BCE. These weren't merely practical storage, but represented forward planning, setting aside surplus for future consumption or exchange. Temples managed much of this storage. They had resources to build large granaries, employed scribes to track deposits and withdrawals, and commanded social authority that discouraged theft. Depositing grain with a temple was an early form of banking. An institution held assets on behalf of individuals who could claim them later. This system's strength was tangibility. The grain existed physically. Its value was intrinsic, but the weaknesses were equally tangible: spoilage, pests, fire. Long-term preservation was uncertain. Metals emerged as an alternative once mining and metallurgy developed. Gold and silver ornaments from ancient Egypt served both decorative and savings functions. They were wearable wealth, easily hidden or transported. The development of coinage in Lydia around 600 BCE standardized this practice. Coins were portable savings that could be accumulated, hidden, and eventually spent or passed to heirs. The Roman Empire's vast coinage system enabled unprecedented savings behavior. Soldiers received pay in silver denarii. Merchants accumulated coins from trade. Wealthy families held substantial metallic reserves. The coins found buried throughout the former empire, thousands of hoards cataloged by archaeologists, testify to widespread savings in metal form. But as discussed in the previous narrative on debasement, Roman currency degraded over centuries. Savings held as coins lost value gradually. Those who hoarded early high-purity denarii preserved value better than those holding later debased versions. The lesson was subtle. Even tangible metal wasn't perfectly secure if the issuing authority manipulated it. Land ownership and inheritance. Medieval Europe developed a different approach centered on land. The feudal system granted land in exchange for service, creating a hierarchy where land equated to both income and status. For the nobility, land was the primary form of wealth preservation. Land had advantages over portable wealth. It couldn't be stolen easily. It generated ongoing income through agricultural rents or production. Most importantly, it could be passed through inheritance, making it dynastic wealth that transcended individual lifespans. Legal structures evolved to protect this arrangement. Primogeniture, inheritance by the eldest son, kept estates intact across generations rather than fragmenting them. Marriage contracts included land transfers. Disputes over land ownership filled courts because the stakes were so high. For those without land, other tangible assets served similar functions. Artisans owned tools, looms, anvils, workshops that represented accumulated capital and could be passed to children. Merchants owned ships or traded goods. Each represented savings in durable form. But land had limitations too. It was illiquid, couldn't be quickly converted to other forms of value in emergencies. It required active management, and political upheaval could result in confiscation, especially during wars or regime changes. The stability of land ownership depended on broader institutional stability. Early modern banking and paper claims. The Renaissance and early modern period saw the gradual emergence of banking institutions that offered new savings mechanisms. Italian merchant banks accepted deposits and paid interest. The Bank of Amsterdam, founded in 1609, pioneered deposit banking where accounts could be transferred rather than withdrawn in coin. These systems introduced a new form of savings, claims on institutions rather than tangible assets. A bank deposit was a paper relationship, a ledger entry indicating the bank owed the depositor a certain amount. This abstraction offered advantages: safety from theft, ease of transfer, potential interest earnings. But it also introduced new risks. Bank failures could wipe out savings entirely. If the institution collapsed, paper claims became worthless. Unlike grain or metal or land, which existed independently of institutions, banking savings depended entirely on institutional integrity. The history of banking is punctuated by failures. The Bardi and Peruzzi banks of Florence collapsed in the 1340s, destroying depositors' savings. The Medici Bank failed in the 1490s. Later centuries saw recurring banking panics where depositors rushed to withdraw funds, often finding insufficient reserves. Despite these risks, banking gradually became preferred by those engaged in commerce. The convenience outweighed the danger for many. And over time, regulations and insurance schemes emerged to reduce, though never eliminate, the risk of total loss. Government bonds and sovereign credit. Parallel to banking, governments developed borrowing mechanisms that became savings vehicles. British consols, perpetual bonds paying annual interest, allowed citizens to lend to the government in exchange for steady income. These bonds were tradable, creating a market where savings could be held in sovereign debt. This represented another layer of abstraction. Bondholders own not tangible assets but legal claims on future government revenues. The security depended on the government's willingness and ability to honor obligations, factors outside any individual's control. The advantage was liquidity and income. The risk was sovereign default, which occurred periodically throughout history. Spanish defaults in the 16th and 17th centuries wiped out bondholders' savings. French debt was repudiated after the Revolution. The pattern repeated globally. Unintended consequence, new vulnerability. The gradual shift from tangible to abstract savings mechanisms, from grain and metal to bank deposits and paper claims, offered genuine benefits in terms of convenience, security from theft, and income generation. But it also introduced dependency on institutions and legal systems. When savings took tangible form, their loss required physical destruction or theft. When savings became paper claims, their loss could occur through institutional failure, legal repudiation, or systemic crisis without any physical event. The risk was different in character, less visible but potentially more total. This wasn't necessarily worse. Institutional risk could be managed, diversified, insured. But it was different, and it required trust that institutions would persist, that legal frameworks would be honored, that social systems would remain stable enough to enforce claims. Across these varied historical contexts, certain patterns recur that reveal consistent aspects of human behavior around savings. Preference for tangible over abstract. The first pattern is the persistent preference for tangible assets, particularly during periods of instability. Even as banking and paper claims became available, people continued holding physical goods, gold, silver, land, commodities, whenever trust in institutions weakened. This preference reflects rational risk assessment. Tangible assets exist independently of social agreement. A gold coin has value even if governments collapse. Land produces crops even if legal systems fracture. Paper claims, by contrast, depend entirely on institutional continuity. Archaeological evidence confirms this pattern. Coin hoards cluster around periods of political instability, Roman crisis of the 3rd century, medieval invasions, early modern wars. People buried savings when they feared institutions couldn't protect them. They reverted to the oldest method, physical concealment, adaptation to changing conditions. A second pattern involves adaptation when circumstances change. When currency debased, people shifted to hoarding older coins or precious objects. When banking emerged, merchants gradually adopted it despite initial skepticism. When government bonds became available, those seeking income diversified into them. This adaptation wasn't instantaneous or universal. New savings methods coexisted with old ones for long periods. Merchants might hold both land and bank deposits. Families might bury some coins while also lending to banks. The portfolio approach, diversifying across different forms, emerged naturally from experience with various methods' strengths and weaknesses. Intergenerational thinking. A third pattern relates to the time horizon. Savings often aimed not just at personal security but at providing for descendants. Land ownership made this explicit, estates passed through generations. But even grain storage or coin accumulation often had intergenerational dimensions. This thinking shaped choices. Assets that could be inherited, land, precious metals, family businesses, were preferred over those that couldn't. The goal wasn't just to preserve value across one's lifetime, but across the family line. This motivated concern with durability and institutional stability, the liquidity trade-off. A fourth pattern involves the tension between security and liquidity. Tangible assets like land were secure but illiquid, difficult to convert quickly to other forms. Paper claims were liquid but less secure, easy to transfer but dependent on institutional reliability. Different people and periods struck this balance differently based on their situations. Merchants needed liquidity for commerce, pushing them toward banking despite risks. Nobility prioritized long-term security, favoring land despite illiquidity. Periods of stability encouraged more liquid holdings. Periods of instability drove flight to tangible assets. Learning from failure. A fifth pattern is the role of institutional failure in shaping preferences. Bank collapses discouraged banking for generations in affected regions. Sovereign defaults made government bonds unpopular until memory faded and new governments established credibility. Land confiscations during wars reduced land's perceived security. Each failure adjusted collective understanding of risks. but memories were imperfect and incomplete. Later generations, without direct experience of past failures, often rediscovered risks their ancestors had learned to avoid. The pattern of adoption, crisis, skepticism, and eventual readoption repeated across contexts. These patterns suggest savings behavior reflects not fixed preferences, but ongoing adaptation to experiences, technologies, and institutional environments. The forms changed, but the underlying challenge, making value endure across uncertain futures, remained constant. The patterns visible in historical savings methods echo in later developments, though the specific forms evolve with technological and institutional changes. The 19th century saw the expansion of life insurance and pension systems, mechanisms for ensuring future security through contractual claims on institutions. These followed the pattern of abstraction. Savings took the form of legal entitlements rather than physical assets. The trade-off remained familiar: convenience and professional management in exchange for dependency on institutional stability. The 20th century brought government-sponsored social security systems, which represented another layer of abstraction, claims not on private institutions, but on future government revenues and political commitments. The security of these savings depended entirely on continued social and political willingness to honor obligations across generations. The echo of medieval reliance on sovereign credibility was clear, though the mechanisms differed. Later decades saw the growth of equity ownership and retirement accounts invested in corporate stocks. This pattern resembled earlier shifts, moving from tangible, land, buildings, to abstract, shares representing partial ownership claims. The advantages were liquidity and growth potential. The risks were volatility and dependency on corporate governance and regulatory frameworks. Throughout these developments, the ancient preference for tangible assets persisted in background. During periods of institutional stress, wars, financial crises, political upheaval, demand for physical gold, real estate, and other tangible stores of value consistently increased. The reflex to hold something physical when abstract claims felt uncertain proved remarkably durable across centuries. Even in highly financialized modern economies, people maintain portfolios that mix tangible and abstract assets. Real estate ownership remains culturally and economically significant. Precious metals attract buyers during uncertainty. The diversification instinct, developed through centuries of experience with various methods' failures, shapes contemporary savings behavior. The observation isn't that history repeats exactly, but that the underlying tensions, tangibility versus liquidity, security versus convenience, immediate control versus institutional leverage, persist. Each era's specific solutions reflect available technologies and institutions, but the patterns of adaptation and the trade-offs considered remain recognizably consistent with those visible in ancient grain storage and medieval land ownership. The question posed at the beginning, how did people across different eras try to make value endure, has an answer visible across millennia of human experience. Preservation of savings was never automatic. It required active judgment about which forms of wealth would remain valuable, which institutions could be trusted, which risks were acceptable in exchange for which benefits. The methods evolved, from grain to metal to land to paper claims, but the underlying challenge remained constant, bridging present surplus and future need across uncertain times. What's striking isn't the diversity of methods, but the persistence of effort. Across vastly different contexts, people saved, setting aside resources, choosing durable forms, adapting when circumstances changed. The behavior reflected foresight and planning, fundamental aspects of human economic life. The Roman coin hoard found beneath a villa floor represented one person's attempt at this preservation. It failed because the owner never returned, but it succeeded in another sense. The value endured, archaeologically if not economically, as evidence of persistent human concern with making today's security relevant to tomorrow's needs. Savings endure through thoughtful choices across eras, not because any single method is perfect, but because adaptation and diversification reflect accumulated wisdom about managing an uncertain future. Understanding this history reveals savings not as technical financial practice, but as fundamental human behavior shaped by universal challenges and local constraints.